Warren Buffett, 7 Mistakes Every Investor Makes. Welcome to the Investors Community channel. Today, we're diving deep into the world of investing, exploring 7 common mistakes that even seasoned investors sometimes make. We'll be drawing wisdom from none other than Warren Buffett, the Oracle of Omaha himself, whose investment strategies have consistently outperformed the market for decades. If you enjoy our content, be sure to hit the like button and subscribe for more valuable insights. Alright, let's talk about the first mistake: chasing after trends. It's so tempting to get caught up in the hype of the latest hot stock or investment fad. The excitement is palpable and it feels like everyone around you is jumping on the bandwagon. Everyone's talking about it, the news is covering it non-stop, and you feel like you're missing out if you're not in on the action. The fear of missing out, or FOMO, can be incredibly powerful and persuasive. But Buffett warns against this. He emphasizes the importance of not getting swept away by the crowd. He's all about finding those solid, undervalued companies with strong fundamentals, the ones that will stand the test of time. These are the companies that have a proven track record, a strong business model, and a competitive edge in their industry. Remember, real wealth is built over the long term, not overnight. It's about patience, discipline, and making informed decisions based on thorough research. As Buffett famously said, the stock market is designed to transfer money from the active to the patient. This means that those who are constantly buying and selling, trying to time the market, often end up losing out to those who take a more measured, long-term approach. So be patient, do your research, and don't let the fear of missing out lead you to make impulsive decisions. Instead, focus on building a diversified portfolio of high-quality investments that you can hold for the long term. Educate yourself about the companies you're investing in, understand their business models, and keep an eye on their financial health. This will help you make more informed decisions and avoid the pitfalls of chasing after trends. It's also a good idea to consult with a financial advisor who can provide you with personalized advice based on your individual financial situation and goals. They can help you develop a long-term investment strategy that aligns with your risk tolerance and time horizon. Diversification is key to managing risk and achieving long-term financial success. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce the impact of any single investment's poor performance on your overall portfolio. In the end, the goal is to build a portfolio that can weather market fluctuations and provide you with steady, long-term growth. This requires patience, discipline, and a commitment to staying the course, even when the market gets volatile. So take a page from Buffett's playbook and focus on the fundamentals. Avoid the temptation to chase after the latest trends, and instead, invest in high-quality companies with strong long-term prospects. By doing so, you'll be well on your way to achieving your financial goals and building lasting wealth. Remember, investing is a marathon, not a sprint. Stay patient, stay informed, and stay focused on the long term. This one's huge, guys. Emotional decision-making is one of the biggest pitfalls in investing. Emotional decision-making can absolutely wreck your investment portfolio. It's like letting your emotions drive your car. You're bound to crash. We've all been there, right? The market takes a dip and you panic, selling everything off at a loss. It's a gut reaction, but it's often the wrong move. Or it's the opposite, the market's soaring, you get caught up in the euphoria and end up buying at the absolute peak. The fear of missing out can be just as dangerous as the fear of losing everything. Buffett's a big advocate for keeping a cool head. He often says that temperament is more important than intellect in investing. He's all about logic and reason when it comes to investing. He believes that you should make decisions based on facts and analysis, not on what your heart is telling you in the heat of the moment. Remember, you're not playing a game of chance here, you're investing in businesses. These are real companies with real products and services, not just numbers on a screen. So, next time you feel your emotions getting the better of you, take a step back, breathe, and remember Buffett's words. You should invest in a business that even a fool can run, because someday a fool will. This means looking at the long-term potential and stability of a business, rather than getting caught up in short-term market fluctuations. It's crucial to develop a strategy and stick to it, regardless of market conditions. This might mean setting specific criteria for buying and selling, or it could involve regular portfolio reviews to ensure you're on track with your goals. And don't forget the importance of continuous learning. The market is always changing, and staying informed can help you make better decisions. Read books, follow reputable financial news sources, and consider seeking advice from experienced investors or financial advisors. By keeping your emotions in check and focusing on sound investment principles, you can navigate the ups and downs of the market with confidence. Remember, investing is a marathon, not a sprint. Patience and discipline are your best allies. Okay, let's talk about the importance of fundamentals. Buffett's a big believer in really understanding the businesses he invests in. He digs deep into their financials, their management team, their competitive advantages, everything. He doesn't just jump into an investment because it sounds good on paper. He wants to know what makes that business tick. As he famously said, never invest in a business you cannot understand. And you know what? That's advice we can all apply, even if we're not investing millions like Buffett. Take the time to learn about the companies you're considering. Understand their products, their market, their financials. The more knowledge you have, the better equipped you'll be to make informed investment decisions. Chapter 4. Ignoring the importance of patience. Patience, my friends, patience. That's one of the biggest keys to success in investing, and it's something Buffett emphasizes time and time again. He's not about trying to time the market, jumping in and out of stocks to try and make a quick buck. He's in it for the long haul. He finds those undervalued companies with strong potential and he holds on to them, letting them grow and compound over time. Remember what he said? The stock market is a device for transferring money from the impatient to the patient. So, be patient, stay focused on your long-term goals, and don't get sidetracked by short-term market fluctuations. Now let's talk about risk. It's a word that can make some investors nervous, but the truth is, every investment carries some level of risk. The key is understanding that risk and making sure it aligns with your own personal risk tolerance. Buffett's a big believer in not investing in things you don't understand, and that's because lack of understanding can lead to underestimating risk. He once said, "Risk comes from not knowing what you are doing." So do your research, understand the potential downsides of any investment, and make sure you're comfortable with the level of risk involved. Overtrading, it's a trap that can really eat into your returns. It's a common pitfall for many traders, especially those who are new to the market or those who get caught up in the excitement of short-term gains. The allure of quick profits can be tempting, but it often leads to a cycle of constant buying and selling. You know how it goes, you see an opportunity, you make a trade, then another, and another. Each trade feels like a step towards financial success, but in reality, it can be a step towards financial strain. The more you trade, the more you expose yourself to market volatility and the whims of short-term price movements. Before you know it, you're constantly buying and selling, racking up trading fees and potentially missing out on long-term gains. These fees can add up quickly, eating into your profits and sometimes even turning gains into losses. Moreover, the stress and time commitment of managing frequent trades can take a toll on your mental well-being. Buffett's approach is much more measured. He doesn't get swayed by the daily fluctuations of the market. Instead, he focuses on the bigger picture, looking for companies with strong fundamentals and a competitive edge. His strategy is about patience and discipline. He's all about finding those quality companies and holding on to them for the long term. This approach not only minimizes trading fees but also allows investments to grow and compound over time. It's a strategy that requires a deep understanding of the companies you invest in and a commitment to staying the course, even during market downturns. He's famously said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." This quote encapsulates his philosophy of long-term investing. It's a reminder that true wealth is built over time, not through a series of rapid trades. And you know what? There's a lot of wisdom in that. By focusing on long-term investments, you can avoid the pitfalls of overtrading and the stress that comes with it. You'll be able to sleep better at night, knowing that your investments are based on solid research and a long-term perspective. Don't get caught up in the frenzy of constant trading. It's easy to get overwhelmed by the noise of the market and the pressure to act quickly. But remember, investing is not a sprint, it's a marathon. Take the time to research and choose your investments wisely. Focus on finding those long-term winners and let them do their thing. Over time, you'll likely find that this approach not only leads to better financial outcomes, but also a more peaceful and rewarding investment experience. So, take a page from Buffett's book and invest with patience and confidence. Last but not least, let's talk about the importance of continuous learning. Buffett's a voracious reader. He's always trying to expand his knowledge and understanding of the world, and that includes the world of investing. He believes that the more you learn, the better equipped you'll be to make smart investment decisions. As he puts it, the more you learn, the more you earn. And you know what? He's right. The world of finance is constantly evolving. There's always something new to learn. So, make it a habit to read books, articles, listen to podcasts, attend webinars, anything you can do to stay ahead of the curve and continue expanding your investment knowledge. Warren Buffett's investment journey provides valuable insights into the common mistakes that investors make. From chasing trends to neglecting fundamentals, these pitfalls can hinder even the most well-intentioned investors. By recognizing these pitfalls, investors can refine their strategies and work towards achieving long-term success. For those interested in delving deeper into Warren Buffett's investment philosophies and common mistakes to avoid, further resources can be found in his annual letters to Berkshire Hathaway shareholders and various interviews that highlight his thought process. See you in the next video. Don't forget to subscribe to not miss out on more helpful videos.